The global reinsurance industry saw some improvement on pricing and terms and conditions at the mid-year renewals, particularly in loss-affected areas. The question is, just how sustainable is this newfound underwriting discipline? I'm John Weber for IM Best TV. Here to discuss this and the sector as a whole is Senior Director Robert DeRose and Associate Director Scott Mangan. And Scott, the name of your most recent report is Fighting the Last War. What exactly does that mean?
Well, it started off obviously as a military expression where military tactics used in the past aren't necessarily applicable going forward. And it's also been translated for investors, and we did the same with reinsurance, where the tactics and the strategies that companies use to be profitable in the current market conditions doesn't necessarily reflect what they did in the past, and they have to come up with innovative new ways of conducting business and transacting business. And again, the past is not necessarily a prologue for the future.
Bob, are you concerned that the market can't keep up for reinsurers?
No, I think that the pace of change is going to be different for individual reinsurers depending on their risk appetite. But generally speaking, I think that the losses that were sustained by third-party capital certainly have influenced pricing dynamics, and I think that the traditional capacity and the alternative capacity have responded really in a very disciplined way, and have recognized that there is a fundamental need for change and have adapted to it.
Now, Scott, unlike 2001 and 2005 when there was a commercial response to extreme events with startups, that didn't happen in 2017 and 2018. Why was that?
Well, the way the market was set up at the time was quite different. It was much closer to a capital event in 2001, 2005, and the opportunities were more widespread across the market. What we've seen now in 2017 and 18 was more earnings-related events. Very few, if any, companies really had any capital issues coming out of those 2 years of catastrophes. And I think why there wasn't an influx of traditional rated balance sheets that came into it is that third-party capital, particularly in the property catastrophe space, was already there. So it was just a matter of them coming in and refreshing their funds in that space. And there wasn't that capital crunch that we saw in 2001 and 2005.
I think that really this is very indicative of the fundamental change that has occurred in the market over the last, let's say, decade. First of all, the market opportunities following the events of 17 and 18 are nowhere near the opportunities that existed post 9/11 or post Katrina, Rita, Wilma in 2005. The market is improving, but it's certainly not hardening, and it's not hardening to the extent that it had, in earlier years. And I think that the reason for that is the fungibility of capital. It's just there's so much capital on the sidelines, and it's so easily deployed to market opportunities that the strength of the market opportunity and the duration of the market opportunity is just much more limited than it had been historically. So you're not going to see capital entering the market the same way as it had previously, with rated balance sheets. That's really permanent capital, one that's necessary for a counterparty rating. Collateralized vehicles that are being formed really take the steam out of the market dynamics, and that's probably going to be the way it is going to be going forward.
So why does the reinsurance market continue to attract alternative capital?
Well, again, I think that the third-party investors look at the economics, the potential economic returns, and they contrast that to other investment opportunities. And where interest rates are, it is still relatively attractive, and it also offers them a form of diversification. The property cat losses and losses from property catastrophe insurance and reinsurance don't necessarily correlate with financial markets, and they like that diversification aspect of it.
Bob, what do you see as the opportunities for reinsurers?
Well, I think the opportunities really remain with the strategic relationship that they have with their primary client. Reinsurers know their clients very, very well. They have the underwriting acumen to select risk properly, to price it properly. And I think that they really are going to be more closely aligned with third-party capital, acting as the front runner, so to speak, of accessing the risk, underwriting the risk, and then transforming it to the capital markets. So I think that that's something that's going to continue to evolve going forward. And then also in terms of innovation, new products, new lines of business, new classes of business, new ways to underwrite risk, They're well placed to do that, and third-party capital isn't. They don't have that expertise yet. That doesn't mean that they can't develop it over time. They may very well, but right now the reinsurers have that advantage.
Are you optimistic about where the reinsurance market is headed, Scott?
I think we're cautiously optimistic. There's still a lot to get over. There's concerns about casualty lines of business and how strong the rate adequacy there is. The benefit of reserve development or favorable reserve releases has declined over time. That's another concern. We are encouraged by the continued alignment between third-party capital and traditional balance sheets. That hasn't maybe come to its full prominence yet, but we are cautiously optimistic that things going forward will continue to head positively.
I think there is reason for optimism, but in your opening comments you used the word sustainable. That's the question. We really don't know how sustainable the current pricing and market dynamics are going to be over the longer term. It really is a supply-demand equation, and right now there still continues to be excess supply and demand. While there are new opportunities, it's not nearly sufficient to really totally utilize the supply that's available.
Thanks, Bob. Scott?
Thanks.
Fighting the last war. You can find the full report online at ambest.com. And for AM Best TV, I'm John Weber.